So it's 5 past now. The men have joined, but thank you all for another webinar brought to you by the Australian Trade Logistics Corporation. We're all trying to support you through this coronavirus situation and enable you to not only improve your business, but also survive through this. And today's event is really important. The webinar that we've got for you today is all about reducing trade, which is a critical point, a critical topic, I should say, for all of us included. And this includes a whole range of important categories around trade, debtors, business insurance, a whole range of things that I won't steal Quinton under. So we've got a fantastic partner with Quinton McCauley from Network Steadfast Insurance, who's doing the presentation for us today. For those of you who saw him on last Import Export show, within 10 minutes he opened up a lot of eyes. I got so much feedback. What you're thinking about moving forward, and even for the current situation within their business. So today, I'm sure will be a really educational, insightful, and most importantly, opportunity for all of us to really tap into expertise. So today, I'll stop speaking. He's going to go through a PowerPoint presentation and cover off the critical parts of the presentation. You can send through your Q&A, some notes, but we'll also have a Q&A session at the end. We do want to be interactive. We do want you to think about some questions, and if you've got anything that's specific that may take a bit more time around your particular business, I encourage you to after the webinar and discuss your personal situation with him directly. So without further ado, I'm going to hand over to Quinton. I'll go on mute and look forward to speaking to you in the Q&A session. All the best.
Thanks, Lawrence. Hopefully, can you see me, Lawrence? Just want to make sure.
Yes, yeah.
Okay.
Yeah.
Right. Thanks everyone for joining today. Look, we have an incredibly exciting partnership with the Australian Trade and Logistics Corporation. That started late last year, and we've done a lot of work with clients, even in the last 6 months. What we didn't envision, I guess we're all in the same boat, 6 months ago, that things would take the turn that they have in terms of the virus coming out and having such a big impact on all sectors of the economy. That does have insurance implications. I'll speak to some of those today. Please do feel free to ask any questions as I go on. And I'm going to cover off key aspects of risk and how insurance responds to those, and particularly talk about some things that a lot of business owners and CFOs, people involved in risk management of their client, their businesses, can overlook unless they're advised properly. The arrangement we have in place for all ATLC members is, if you're unsure about anything to do with risk and your insurance program, please do come to us. We will look after you. You may not have received the level of advice or expertise that you need to cover your business risks appropriately. We have a large team that manage clients nationally in covering a whole range of business sectors, and can provide you a level of advice that you probably wouldn't have received before. In terms of cost, we don't charge at all for those reviews. We simply will charge fees at the next insurance renewal, and we guarantee for all ATLC members those will be quite a bit less than what you're being charged at the moment. So with that, I'll start with the PowerPoint presentation. Please do ask any questions as we go along, and I'll screen share from now. So I'm talking today about essential risk strategies for businesses in the trade and logistics sector, and that includes importers, exporters, any business involved in supply chain services as well. So you've got Forex, logistics, and transit, warehousing. Third-party logistics is a growing sector as well. Container packing and unpacking. We've got a member, GDA, that we're working really closely with at the moment. And so I'll cover these topics relating to these sectors. I'll start off talking a bit about who we are as a business. Network Steadfast. So we are Australian Trade and Logistics Corporation's exclusive risk and insurance partner. First of all, we're risk and insurance consultants. We're not insurers. It's really important to make that distinction. I think it's easy, if you're not familiar with insurance, to confuse an insurance broker or a risk advisor with an insurance company. Two very different things. So insurers are the ones that will offer policies and underwrite the risk. We're the ones that understand your business, take the time to do that, and design an insurance program that's appropriate to those risks. So we're not insurance companies. We're a national business, so we have around 25,000 clients. We manage $155 million in premiums for our clients nationally. And we're majority owned by Steadfast Limited, which is a listed company, and that is the largest single insurance broking network in Australia. In saying that, we also, we're not a big corporate. We don't treat our clients like we 30% of our business is owned by two directors who are both Australian born and raised, and we have a real affinity with I guess the Australian businesses, but also any businesses that are seeking to work with and help facilitate global business of Australian clients. We've got access to over 125 insurers, and most of those are in Australia, but we also deal with a number of insurers overseas in Lloyd's of London and Singapore particularly. That's an emerging market in terms of insurance, and when things are complex, sometimes it's more cost effective and get a better result by going to overseas insurance markets. A lot of small broking firms are unable to do that. They just don't have the scale and capacity to do that. We sort of sit in a space where we're big enough to have the leverage that you really need in today's insurance market to get the results that our clients need. But we're also small enough where the right hand does talk to the left. We all have a very personal relationship with our clients, and we treat the culture in our business is to treat our clients as if they were family, and we really take pride in building those strong relationships. And you can't deliver, one thing that we've found is you can't deliver the results long-term for clients and design appropriate insurance if you don't have a close relationship and intimately understand the mechanics of their business. In terms of outside of pure insurance broking, we also provide a dedicated claims management team. So we have a team of 12 nationally. We do have an in-house law firm that can provide advice when claims get complex or disputed. We really go into bat for our clients when that sort of thing happens, and it does frequently, particularly in the current insurance market, which is getting tougher by the day. We also have a in-house specialty workers' compensation team. One of the biggest expenses to any business, particularly if you're in manufacturing, import, export, freight, logistics, one of the biggest expenses is workers' compensation. And the work that our team do to reduce claims in terms of early intervention, securing better results in terms of claims management is absolutely outstanding. And we've had a number of clients that have really seen the benefit of that in the last 12 months. The other thing that we do is provide claims. The other thing that we do is partner with specialists to undertake detailed reviews of business interruption insurance and loss of profits. They're saying it's a business called LMI that specialises in that area. And they also provide detailed risk assessments and risk analysis. And partnering with risk engineering companies and consultants is really important when it comes to positioning particularly your property insurance risk to insurers, where they conduct their own risk assessments. Often those will be biased in favour of the insurer. We like to do those ourselves, and it comes at a cost, but we work with our clients to manage that. And generally, you can get a much better result on large property insurance renewals when you have a risk engineer involved, working for us, working for you, the client, to paint your risk profile in the best light possible, and assist, more importantly, with risk improvements as well. So I want to talk today about some key risks, and those, if you look at business in terms of the substance of the business and the lifeblood of the business, and then its exposures to claims by third parties, I like to split it up into two primary categories. And one is assets and revenue, and that's what's the asset? What are the main assets in your business? And that's your property, your static property. So whether that's buildings or contents, stock, and then you've also got your revenue tied to that. So if you had a large fire, your revenue stream could dry up pretty quickly, and you can insure to protect that, as most of you probably know. Marine cargo, so your property in transit. Trade credit, and this is often overlooked, and we're seeing a lot of queries from clients coming in now around their trade credit exposure. I'll talk more about that, but it's essentially insuring your debtors ledger, and the risk of insolvency and non-payment of your own customers is really high in the current environment. So insurance for that is actually drying up, and I'll talk a bit about that. But I would highly recommend that anyone with potential exposure look to get that insured from now, so that you've got cover in place if it does happen. Product recall, and that's that's the costs that you incur if you need to recall a product. Now, particularly for many of you importing and exporting, the costs associated with product recall are huge, and it can be, no matter what risk management and quality control practices you have in place, anyone can find themselves hit with a recall, and the costs of that can in some cases bankrupt a business. So you can insure, and often should consider insuring for that exposure. Cyber risk, which I'll talk to as well, is probably the fastest growing insurance product in Australia, cyber insurance, and that reflects the risk. The claims coming through for cyber insurance are escalating by the month. The trend is incredibly strong and it's partly because Australia is perceived to be an easy target. Insurance for that, business interruption insurance particularly, and covering your liability exposures with data protection are really critical. Speaking of liability exposures, the other side to your business risk is really your liability risk. And for many of you, it'll be your public and products liability. If you're providing any sort of professional advice, professional indemnity becomes a really key concern. Other than that, it's no matter what business you run, a management liability exposure is really important to address. You're personally liable as directors and officers or managers of a business for the decisions that you make in running a company. And that includes, you've also got regulatory exposure to fines and penalties, and employment practices liability. And that's where you are sued by employees for things like unfair dismissal or redundancies that weren't managed properly. Obviously a huge concern for the current environment. And even harassment and bullying, which can happen in your workplace outside of your control and knowledge. I'm just going to check for any questions.
I don't think we haven't got anything at the moment, Quinton.
Okay. I'll resume to the screen share. So we're going to talk about property and business interruption. What should worry you? What are the biggest exposures and often overlooked exposures? Everyone knows that you insure property, you take out property insurance for buildings, contents, stock. And that really to be of. Underinsurance is probably, most people are probably aware that if you have $1 million of property and you insure it for $500,000, if you have a claim, if you have a total loss, the maximum that you can claim is going to be $500,000 because that's all you've been insured for. What people don't understand a lot of the time is that if you're underinsured by 50% and you have a partial loss, so for instance, a $200,000 claim, the insurer is entitled to only pay you 50% of your claim. So the insurer is entitled to reduce your claim payment for small losses to the extent that you've underinsured. So it's really important to make sure that you insure for full replacement value. Insurance needs to be a live program. So this is not something a lot of businesses, and unfortunately in the insurance industry, a lot of, I'd suggest some brokers don't emphasize this enough to their clients, the importance of modifying your insurance and reviewing it as your business changes throughout the year. So things like fit outs. In the current environment, some supply chain disruption has happened, but you've also had industries where we're seeing businesses take on much larger orders than usual. They've suddenly got twice the amount of inventory sitting in their warehouse than they would otherwise. Seasonal fluctuation is another aspect of that. So as your asset values, whether that be generally contents and stock, change throughout the year, it's important to make sure that you've insured adequately. The risk of a claim happening is generally a lot higher when your business is stretched. And when people have got twice the amount of work happening, they may not be paying attention to risk management practices as much as they normally would. So the risk is higher. It's really important to make sure that you review your insurance values throughout the year as the business changes. Now, the other point I wanted to talk about was customers' goods and stock on consignment. So your property insurance policy, whether that's on what we call an industrial special risks policy, which is for larger corporate business, or a business package, which is generally more for the SME commercial space. Those policies will cover customers' goods and often stock on consignment up to a certain limit, usually undeclared. But if you've got a lot of goods that you're either holding on consignment or you've even got in a third party's warehouse and you haven't declared it, or you're holding customers' goods yourself, you may not have cover for that under your property insurance program. Your liability insurance will cover you up to a certain limit if that stock is lost or damaged because of your negligence. But the problem is you can't rely on that because plenty of claims can happen that have nothing to do with your negligence. We had a client, and this was, I had a client, and this was about 8 years ago that I picked up one as a new business account, and that had a terrible experience where they had they imported product, makeup product from overseas. They held it in their warehouse, and they were holding it on consignment, so they didn't actually own the stock. And a fire happened in the building next door, and it burnt down their own building, and they had $1.2 million worth of stock, which they had no ownership interest in, and they hadn't declared on their insurance. They of course got a demand from the owner of the stock, and they then sent that to their liability insurer and said, we're being sued for this, so can you cover us? The liability insurer came back and said, there's no allegation of negligence here that's caused the loss. It's just the fact that you guys were responsible for it because you held it on consignment. So the liability insurance did not actually respond, and the client was left holding a $1.2 million loss on their own balance sheet. So it's really important. The way to address that is to make sure that if you are holding stock on consignment or customers' goods, and also if you've got your own stock and your customers are holding it on consignment in other locations, make sure you declare it to your insurer or your insurance broker, and make sure that your insurance policy actually clearly reflects those values. I'll talk about business interruption. Under insurance, which I talked about in regards to property insurance, under insurance also applies to business interruption. We have a team who we work with of CPA qualified insurance specialists, and all these guys do is review business interruption insurance against profit and loss statements, review it for seasonal fluctuations, look at the expenses that you're insuring versus the truly variable expenses that you may not need to insure, and make sure that your insurance values actually correctly reflect the profit that you're bringing in and the fixed expenses going through your P&L. For clients that we pick up, around 80% of business interruption insurance policies are not correct, and a lot of those they're either over-insuring certain parts or they're under-insuring. More commonly, they're under-insuring because they just haven't been updated for a few years. They might have been you might have taken out business interruption 3 or 4 years ago and not sat down and reviewed it properly. So as part of our service, we have a CPA qualified team that will review your profit and loss statements and make sure that your business interruption insurance truly reflects the profit going through the business. There are a number of, I guess, ways that you structure business interruption where you've got cover for your immediate short-term risk. For instance, if you have a large loss, the most important period is to insure is the first few months, the first 6 months, the first 12 months after you have a major loss, like a fire that completely destroys a warehouse, for instance. After that, it starts to be your exposure starts to reduce. It starts to be a bit of a sliding scale. So one way of ensuring your immediate, the short-term risk fully and reducing your cover further down the track is to take out dual payroll cover. And that's instead of insuring your entire wage roll for a full, say, 12-month period or 8 or 24-month period. Really, most businesses should have at least 24 months of business interruption cover. So instead of insuring the full payroll for that whole period, you consider, do you have casual staff? Are there people that aren't critical to the ongoing operation of the business, that if you did have a total loss, like a fire, could you might want to keep those people on for the first 6 months, and then after that, you may want to drop to only insuring half your payroll, because you're insuring the management team in the business, and then critical staff that you really need to stick around so that they're still there when the business gets back to where it was before the loss, once everything's been recovered and rebuilt. So that's a way to save on premium. There are a few creative ways that you can reduce your costs while making sure that your key risks are still covered. The other thing that's really important to consider is how long would it really take you to recover after a large claim, after a large loss. Almost every client underestimates how long it would take them to get back to their pre-loss profit levels. And that's what you're looking to ensure when you cover business interruption. So 6 months is never enough. I'll say that now, 6 months is never enough in terms of the time period that you take out business interruption cover for. You definitely need to at least insure for 12 months and ideally for 24 months or possibly longer for larger businesses. And particularly if you own buildings, the time it takes to remove debris, to get DAs for rebuilding, go through councils and the approval process, get architects to design it, get the actual building contract tendered out, start the build and finish it, and then deal with defects and then be ready to move in, and then set up your equipment and possibly machinery, or let customers know that you've set up again. The time it takes to really recover 100% of your profits and get back to where you were after a large loss is a lot longer than 12 months. So our advice is certainly insure at least a minimum of 12 months for business interruption, but consider insuring for longer periods. Something else that's really important, particularly if you're in the import and export sector, is considering your dependency on large suppliers and customers. Your business insurance can cover loss of profits if a large supplier or customer has an event that would be covered if it happened at your premises. So a good example is fire or storm. You'd be covered if a fire or storm happened at your premises. You may have 80% of your product coming from one supplier, a contract manufacturer in China, for instance, or 80% of that product may be going to one customer. You might have just won a large contract with Bunnings or a restaurant chain, for instance. If that customer or supplier has a couple of large locations where if a fire or a storm happened at one of those locations, what would the impact be to your flow or to your supply chain in terms of the demand from that customer or the availability of supply from your supplier? If that cuts off as a result of an incident that would be covered if it happened to you, you can arrange insurance to cover that exposure. So it's really important to consider. You can have all the insurance in place for your own business directly, but you're also heavily dependent, and especially today more than ever, as we've probably found out with the coronavirus, that we're very dependent on both our suppliers and customers, and particularly if you've got a large portion of your product either coming from or going to one of those parties. So it's important to consider that from an insurance point of view. I want to talk a bit about coronavirus and a lot of our clients over the last few months have, of course, very understandably had questions about whether they're covered for business interruption as a result of things like shutdown orders or the coronavirus outbreak. Unfortunately, business interruption insurance is designed to cover loss that results from material damage, whether that's happening at your premises or, as we were talking about before, suppliers and customers' premises. But really it's designed to cover business interruption loss following material damage happening at your premises. Coronavirus is not a material damage event. It's very different to a fire or a storm or impact, a truck going through the warehouse or the office, or a flood, for instance. And on top of that, all business interruption insurance policies in Australia have an exclusion on pandemics and quarantinable diseases. So unfortunately, there's no cover for that. But in saying that, our experience with clients has been there's not a lot of expectation that insurance would respond. Pandemics and quarantinable diseases are generally not something that you can insure, because it would send every insurer bankrupt in Australia if you had to insure loss resulting from a virus outbreak like that. The important thing with business interruption is if you have been closed down as a result of the virus, or you've had your business severely restricted and you're looking to save costs, it's very important not to remove business interruption cover if you have it already. And now that's because you don't know when business is going to be reopened. So, for instance, we have businesses that are deemed non-essential services. So, pubs are a good example. We've got pubs that have been closed down. They have had business interruption cover. They've called up asking if they should remove it because they've got no revenue going through the business at the moment, so they've got nothing to insure. The problem with removing that is you could remove your business interruption cover, and then a day later you have a fire, the building burns down, and then a month later the restrictions get lifted and the economy is open for business. Now, if you had 12 months of business interruption cover, you've just lost a good 11 months worth of loss of profits insurance, which you could have had if you kept the cover in place. Your business interruption cover would have kicked back in as soon as you would have been earning revenue. I hope that makes sense to everyone, but if anyone's got questions, please feel free to ask. Vacant premises risks. If there are any of you that do have premises that either you may be a property owner that's had a tenant close down, or you may have closed down business yourselves temporarily, it's important to disclose that to the insurer. Most property insurance policies will have a clause where if your property's unoccupied or it's vacant for more than 30 or 60 days, the insurance cover won't protect the property unless it's been agreed and disclosed to the insurer. That's really important to disclose that. And then there are some basic risk management processes you can put in place just to reduce the risk around vacant premises. And we can, if you're in that situation, please talk to us and we can give you some tips. So I'll talk a bit about marine cargo risk, marine transit risk. If you rely on overseas suppliers insurance or freight forwarders insurance, and look, we see this all the time where a business is importing or exporting a product and they're reliant on the insurance that's provided by the freight forwarder or even by the supplier if they're purchasing it. There are two problems with this. One is cost and the other one is control. From a cost point of view, generally speaking, freight forwarders will mark up the insurance cost and make a small margin on it. So you're generally paying more for the same product if you go through a freight forwarder's insurance as opposed to arranging it yourself. The second point is control. If something goes wrong and you've got product that you're relying on insurance arranged by another party, it's very difficult to control what happens if at the time of claim and how their insurer approaches settlement. You've got uncertainty of cover. So for instance, do you know that you're covered for the inland transit risk after it gets unloaded at the port, or does cover cease at the port? The last thing that you want to do is to be in a dispute with a supplier or a freight forwarder about the outcome of an insurance claim. And we recommend that all businesses, you're going to have to bear the cost anyway. There's always a cost, even if it's hidden, there's always a cost in your to have insurance cover. So it's far better to be clear about what that cost is yourself and to have control over your own insurance. So bring control in-house, we say. It's easy, very easy to arrange, cover's cheap, it's flexible, and it can be tailored to your specific risks, and that's your import, your export, your inland transit as well. One thing I wanted to mention was in relation to coronavirus, the impact on supply chain across Australia has been talked about a lot in the media. In some cases, there has been disruption. In a lot of cases as well, what we've actually seen is orders increasing and limits for marine insurance. Every marine insurance policy, marine transit insurance policy, has limits that you agree at the start of the insurance period. It's really important to make sure that those limits are adequate to cover the maximum sendings that the maximum side value of a shipment that you're bringing in from overseas or perhaps exporting overseas. So again, this is a case of you set the limits and values at the start of the insurance period, but as your business changes, it's really important to review those limits and make sure that they reflect your risk exposure. And for most businesses, and I would suggest most ATLC members, their risk profiles change substantially. And it may not be on every policy. It may only be 2 out of 5 insurance policies that you hold as a business. But you can almost guarantee that there are going to be things that need to be changed on your insurance program to cover you properly. Trade credit risk, which I'll talk about now. This is a hot topic in the insurance market at the moment, and the impact of coronavirus has been massive in this sector, to the extent that, and I'll talk about what it's covering in a second, but to the extent that insurance companies that provide this product, most of them have pulled out completely and aren't offering the product anymore, because the number of claims that are coming through is it's not sustainable. So they've put in some cases, a temporary hold on issuing this product. I'll ask some questions. So how do you assess new clients and monitor their credit risk? Credit references, credit checks are great. You can do those yourself as a business. You can pay someone else to do them. You can get references from other clients that they've had. Or other businesses that they've dealt with. Those processes most businesses follow, and they are okay, but they're not perfect. How do you handle overdue accounts, and what's your exposure if your largest client started to delay payment? What position would you be in? So think of your debtors ledger. That's often one of the biggest assets that a company holds. And on average, 40% of a company's assets are from the debtors ledger. So what happens if your largest client that makes up 30 or 40% of your debtors ledger starts to delay payment and then starts to breach credit terms, and you've got a lot outstanding and you're not quite sure how far to push the relationship? They seem to be in financial stress. You want to keep things pleasant, so you're following up, but you're wondering just how to handle this exposure, and you're starting to feel that anxiety as either a CFO or a business owner, that you've got exposure here, and you're not quite sure how to manage it. We partner with a specialist insurance business, a broker called National Credit Insurance for this insurance product. All all that NCI do is trade credit insurance, and they work closely with credit reporting agencies across Australia. They have around about 40% of trade credit insurance in Australia goes through them. So we're a big believer in working with specialists who are the best in market. And that is part of our service offering to ATLC members. We are very good at what we do. If we can find a partner in insurance that's better at something than we are, we will partner with them, and we work closely with them to make sure that ATLC members have access to the best insurance advice in Australia. So NCI have a trade credit risk index, and you can see there where claims were coming from in 2019. On the left there, the largest one was from the electrical sector, electrical products. And then building, as probably a lot of us would expect, buildings up there. Now these are situations, trade credit insurance claims come where an insured business's customer is unable to pay, either through protracted default or insolvency. So electrical and building hardware is then followed by labour hire, employment agencies, and a number of others that make up a lot of the claims coming through trade credit insurance. The trade credit risk index in Australia in 2019 was the highest that it had been in 3 years, and that was before coronavirus. The situation that we're seeing right now is trade credit risk and insolvency risk is the highest it's been in Australian history. And the fact that you can still, at the moment, depending on the sector that you're in, you can still take out insurance to protect your debtor's ledger and protect against the financial implications of insolvency of your customers. The fact that that insurance is available still is actually astounding. And I would highly recommend that every ATLC member, that if you feel like there is exposure there to your debtor's ledger, and that you would be impacted if your largest clients were unable to pay, please do talk to us or speak to Lawrence, and we can at least arrange quotes for you so you can make an informed decision knowing how much it costs to insure this. The trade credit insurance covers debtor insolvency and protracted default. 90% of a debt is generally recoverable. You can, if you're a large business, you can choose to insure one or two of your couple of largest debtors, your largest clients. For small businesses, if you're below around the 5 mil revenue mark, generally it's more cost effective to insure your entire debtor's ledger. And generally you may have an insurance policy that will cover everything above $10,000. And then what you do is at the start of the insurance period, you set a limit for how much you're going to insure up to. And if you increase a credit limit to one of your clients, all you then do is notify the insurer. Whenever you're taking on a new client, the insurance provider, NCI, will run credit checks for you and do a full quality control and audit process on the background of the credit history of that customer, because they're the ones that are taking on the risk if they fail to pay. But the key thing is that you then, as a business owner, you've got peace of mind. It gives you the confidence to expand. So you can give loyal clients longer credit terms. You can increase their credit terms, the value, their credit limit. And you can also look at, you've got the confidence then to go into new markets, particularly if you're expanding overseas, markets that you may not have been in before. Knowing that you're protected by trade credit insurance, it gives you the confidence to do that. Banks will also take a much more favourable view of your liquidity if they know that you're protected by trade credit insurance. So if you're financing for expansion, it's really important to disclose that to your bank, and generally that can be used as part of the negotiations on finance terms with your bank. So all I'd say with that again is investigate your options now, because trade credit insurance may not be around for the next few months. It still is at the moment, but talk to us if you've got any interest in that area. Excuse me. I'm going to talk about product recall risk. Now this is where you, and I mentioned this before, product recall is where you supply products to either customers direct or perhaps to distributors, and there's some sort of fault. There's something in the product that means it's there's a possibility that it could cause injury to somebody or even property damage. An example of that is a client of ours was importing electrical goods, and toasters were they had a faulty batch of toasters. They had to conduct a full recall. A lot of those had already gone out to market. The costs associated with managing a product recall, notifying your distributors, if you have a product recall insurance policy, that can be set up to cover your distributors' costs as well, which they will often come back and ask you to cover. And the other side of this is the public relations impact of having to do a product recall. Product contamination as well is another a big exposure if you're in the food and beverage industry. So you can take out insurance to cover that. We're all familiar with the needles in the strawberries. So malicious tampering. If you have to recall a lot of your products and destroy it, this insurance will pay for the cost of managing that recall, the cost of destroying your product safely and disposing of it, and the public relations costs as well. So it's really important to consider that, and in addition to and alongside your liability insurance. I'll just see how we're going for time. Make sure that
8 minutes left of the 1 hour session.
Yeah.
So would you like to, I can open up if anyone's got some Q&As, they can just with the Q&A tab post any questions.
Yes, if anyone's got questions, please ask.
Okay,
so I'll continue,
yeah,
Lawrence.
sure.
Sorry, guys, I'm just getting the presentation back up. So this, guys, this links in quite well to my next topic, which is cyber insurance.
Great, yeah, that's the important, especially while people. Just while Quinton on screen, we've had George, who's just, I think Quinton might have mentioned before, but he's basically signing up paperwork today on that risk as a labour hire. So that trade credit risk has already had a direct benefit for there. So.
That's fantastic, and I had a great conversation with George yesterday, and the fact that insurance is still available at the moment is really impressive. Most insurance are pulled out, but there are a couple of insurers that are providing that insurance for specific sectors, it's a lot of negotiation to get that cover in place, but that's we were able to do that. So that's great to hear, George.
And I think the other part that you mentioned there, Quinton, is that because so many businesses, even long-term customers, despite the best of their intentions, it's such a domino effect with the economy around at the moment. Even if they've got every intention to pay you as a supplier, if their customers can't pay them, then the domino straight into your business. So it's not a malicious thing. I'd say 95% of these situations are really regretful, but without that trade credit risk, or at least having the opportunity to consider it, everyone is exposed.
Yeah, absolutely. And a lot of this is about underpinning your client relationships as well, because up front, when things are running well, the fact that you can extend credit terms, longer credit terms and higher limits to really good clients is without being worried about the risk. That's fantastic. And then when things do go wrong, you're not there by yourself trying to manage that exposure. Guys, I'll talk about cyber risk, and I'm conscious we've got 10 minutes to go, so I'll keep on track. But cyber risk, a lot of you, I'm sure, have heard about it from now. It is the fastest growing product in Australia in the insurance space. And the reason for that is it simply reflects the growing risk exposure. We have very firm conversations, I guess, with clients in their interest. We have some clients that choose not to take cyber insurance. We are of the viewpoint that no matter what business you're in, absolutely critical to have this cover in place. This is the virtual equivalent of having a property insurance policy. It's like a virtual fire and business interruption insurance policy. Australia is perceived by cyber criminals as an easy target. Unfortunately, a lot of the time that perception is true. They are increasingly targeting SME and mid-sized businesses that don't have quite the same level of security infrastructure as large corporates. They haven't got an in-house IT security manager who's constantly reviewing and looking for malware and running patches and designing appropriate insurance security, cyber security protections. So SME businesses in Australia are increasingly seen to be an easy target. Cybercrime affected 25% of Australian businesses in 2017. So if you're in a room with 8 people, 2 of those businesses are going to have been affected or had some kind of hacking event or a virus or cyber disruption. The regulators are really toughening up on data protection requirements, and the expectation of every business in Australia is that you have a duty if you hold anyone else's data, whether that's data and information of your employees or your customers or your suppliers or anyone that you have confidential information or sensitive information on, you've got a duty to protect that. And if your system or your network is breached and that data is released or made available to third parties, then you've got potentially a legal liability. There is mandatory notification laws came into Australia in 2018, and those are overseen by what's called the Office of the Australian Information Commissioner. That office can levy fines and penalties if you've had serious or repeated breaches of privacy, because this ties into privacy legislation. So cyber insurance protects a number of points. Firstly, it protects your own risk for loss of data restoration costs, cost of paying a ransom. Insurers will even cover that. if you've got ransomware attacks, that's something that's increasing in Australia at the moment. You're locked out of your system, and unless you pay a certain amount, often in Bitcoin, so it's untraceable, your whole system will be wiped. So insurance can cover that. Business interruption associated with a cyber breach or a data breach, a cyber system failure, that's insurable as well. And any good cyber insurance policy should be structured to cover those risks. The other side to this is your liability exposure, and that's civil and contractual risk. So increasingly now with contracts, we're seeing clauses put into those contracts around you accepting responsibility and liability if there's a data breach of somebody else's information. So you need to have insurance to cover that liability. That is not something that's covered by public liability insurance. Insurance will also cover fines and penalties associated with a cyber breach. And the other thing which is increasing is funds transfer fraud. And that's where you have imposter emails coming from an external source that masquerade or make themselves out to be somebody within the organisation, asking you to change bank account detail, to transfer funds into a bank account. The bookkeeper or the accountant thinks that it's come from you. They make the transfer, and then you've lost those funds forever. And cyber hackers are even hacking into businesses and changing accounts on the system. So cyber insurance can be structured to cover that. In the current environment, we're seeing a lot more reliance on cyber networks, and the work from home measures are good in some respects to keep businesses going, but they do present an increased security risk. So now is more important than ever to take out cyber insurance and make sure that you've adequately protected yourself against those risks. I'm going to take the liberty of skipping through product liability insurance. I think every business in Australia has this in place. There are nuances around liability insurance that it's important to cover. And that's if you sign contracts where you sign away your rights, insurance generally will not cover that risk, and you need to talk to us about that. We can review contracts and make sure your insurance protects. There are some other points in there, but in the interest of time, I'll skip through to the next one. Management liability risk. If you don't have management liability insurance, please take it out and talk to us. It's not expensive in the context of business insurance costs. If you're a director of a business or an officer, you're involved in the management of a company, you can be held personally liable for your decisions or breach of duty in managing and running that business. Your house is potentially on the line, even when you have a company structure in place. So it's really important to cover that exposure. There's a very complex regulatory environment in Australia, which particularly small businesses, unless you have an in-house counsel, you're not going to keep up with it all. You do your best, but it's important to have insurance protecting you for the things that you miss. Management liability insurance will also cover employment practices claims for things like unfair dismissal, harassment or bullying in the workplace, which often happens outside your knowledge or control, and statutory liability as well. If you have fines and penalties levied against you as a director, if someone's injured, for instance, WorkCover will fine the business, and they will also fine you personally as a director. So you need to have insurance in place to cover that, and that's addressed by management liability insurance. Very important in the current environment where you've got redundancies, increased mental health risk of employees who are working remotely. They're more likely to be injured at home, and then you get claims around a failure to maintain a safe workplace. It's important to protect that risk. In closing, I've talked a bit about insurance products and the complexity associated with them. This is a offer that for all ATLC members, and that's the ATLC member insurance health check. Our approach to insurance is not just a product. We take the time to consult with you, understand your business, assess your key exposures. Not all exposures are the same or as high as each other. In some cases, you may be wanting to reduce your cost of insurance. We recommend moving your view of insurance to from covering your working losses to genuine balance sheet protection. In a lot of cases, you may have a $500 excess, but you've got a $3 million turnover business. It might be more economical to take a $5,000 excess and use that premium saving to cover the cost of adding cyber insurance into your program. Because the insurance is about making your business protected and sustainable long-term. So we can give you advice around that. Really important to benchmark your insurance pricing and review your current program for gaps in cover. A lot of the time, more often than not, an insurance policy has just been renewed with the same insurer for the last few years, and it hasn't been really tailored for your business. So the approach that we take is we'll review your current insurance policies if you send them to us. We can then come back to you with advice on remediating them. And then we ask that we don't charge for that at all, but then we ask that you appoint us as your broker to make those changes in your program. We don't charge any fees for doing those mid-term reviews. The approach that we do take is when your insurance next falls due for renewal, we will then charge a fee, but we guarantee for ATLC members that it will be at least 20% discounted on any fees that you're paying already with your current provider or insurance broker. So I think that's the end of my presentation, but does anyone have questions?
We don't have any coming through at the moment. Just to add to that point as well, Quinton, is that definitely apart from the risk protection and saving, I think the proper insurance policies can also enable much better partnerships with your customers and suppliers, and therefore a much greater competitive advantage over your competitors. So it's a really powerful tool as a leverage as well with the right policies in place.
Absolutely. And insurance is often about protecting your reputation as well. Because any uninsured large exposure that your business, if you have a large claim and it's not covered, that's going to generally affect your perception in the marketplace. Whereas if you can, if those risks are protected, your balance sheet's protected, the business can continue, you're going to be a lot better positioned long term.
Fantastic. So just a final thing about any questions coming through. What we will do is, with Quinton's permission, we'll make sure that the people who were on and had to drop off earlier, or some who couldn't make it, we can share this webinar on our YouTube channel as we've done with the other webinar. If that's okay, Quinton, with you, what we'll do is re-invite people to review this and revisit it, so they can reach out to you accordingly as well.
Fantastic.
Great. All right. Well, I don't have any other questions coming through, but again, I appreciate everyone taking the time to be part of today's webinar. I'm sure you found it really insightful and beneficial, and hopefully it's opened up your eyes about some other ways to create an extra value add within the business and your external stakeholders as well. So thanks again, Quinton. We'll put this on our YouTube channel. We'll create a blast out to the database as well around the insurance health check, and we'll encourage all of our members and the broader supply chain community to get in touch and do themselves a favour by checking out where their risk gap analysis is.
Thank you, Lawrence, and thanks everyone for attending.
Fantastic. Thanks everyone. I'll close off the meeting in a second and look forward to seeing you at our next webinar in a couple of weeks on modern slavery reporting for importers and exporters, which is another really important one coming up on the 7th of May. So take care, and we'll speak to you all very soon.